Hi, I'm Dylan Bourke,
And I'm Kris Burney.
and we're going to discuss how the Iranian conflict has impacted fixed income markets and the macroeconomic environment surrounding that.
We hope you find it useful.
We will be discussing how fixed income can be used to generate income, manage volatility, and provide diversification, especially when markets are being driven by unpredictable macroeconomic and geopolitical outcomes and risks. We think we will go through the tug of war between the US AI boom and the Strait of Hormuz remaining shut for longer than many people anticipated, causing a potential global stagflationary shock, and how that has increased the attractiveness of short-dated global investment-grade fixed income strategies, given the uncertainty in today's market environment. And with that, I'll pass to Kris to talk through the macro.
Yeah, good morning, everyone. Thank you again for your time today. Essentially, the main way that the Iranian conflict is actually going to impact the economy and financial markets, and therefore our investments as well, it's really through the oil price. Around 20% of the world's oil supply goes through that Strait of Hormuz, as well as a similar percentage of world supply of things like fertilizers and some other energy-related commodities as well. It is a vitally important strait. And the closing of this strait has seen the oil price more than double to above $100 a barrel, which has really put it up there as one of the more serious events that we've seen over the past few decades when you look at it through the lens of the oil price. Now, why does that have such an impact? Well, obviously, if everyone's spending more money on petrol, they have less money to spend elsewhere. And it also means that you're going to just generally have higher inflation as well, as businesses are going to tend to pass on the cost from higher energy prices through to the final consumer as well. So, yeah, it is a pretty serious event, but the main impact is going to be through the impact of higher oil prices. So if we look what the impact on the markets has been from this conflict, equities actually initially fell around 5% over the course of the first month of the conflict. Now, where does that sit in the grand scheme of things? We have had previous events in the Middle East that have actually generated losses in equities of above 10%. The more serious events have actually had an average of above 10%. So a 5% decline isn't quite in the same category that we've seen in the past. The markets have not treated it as one of the more serious events that we've seen in the past few decades, even if the oil price has elevated above $100 a barrel. And more important, equities have since recovered and again hit all-time highs. It appears that once it looked like President Trump was looking for some kind of exit, even though we haven't seen one yet, equity markets started moving on and thinking about other things. So we saw a pretty sharp turnaround in equities. The same can't be said for rates and bond yields. They haven't reversed their initial post-conflict moves. So why is that? Well, inflation, it's useful to understand the backdrop before we go into what's happening now. Inflation was obviously extremely high after COVID, reflecting primarily supply, but also demand influences. It came down a long way as well, but it's still settled at the high end of what most central banks are going to be targeting. And in Australia, of course, we've seen a recent rise in inflation that's unrelated to the war that we've seen over the past year, which has seen the RBA hike rates on its own. Not too many other developed markets have had to do that just yet. But yeah, inflation was starting from a somewhat elevated level already to begin with. And when you have a conflict where energy prices have gone up like what we've seen, that's just added to the inflation concerns. And on the back of that, we've seen a pretty sharp rise in what most people are expecting in terms of rate hikes. And that's what this right-hand chart shows. This right-hand chart shows that for the US, Europe, UK, Canada, and Australia, in terms of where monetary policy is expected to be by the end of the year, most regions have seen an increase of at least 50 basis points, 0.5%. So it has been quite a sizable shock on markets. The increased expectation of rate hikes has meant that yields have risen pretty sharply as well. So we've seen yields quite significantly higher across most of the regions. UK was actually the leader. Yeah, even here in Australia, we've seen some pretty sharp rises in yields. And the key point that we want to try and make here is that unlike the move in equities, which reversed, yields have just kept on going. So they were actually higher, not just in March, but in April as well. Admittedly, a much smaller amount, but yields have kept on increasing, whereas equities have reversed their initial move. And that's prompted us to think, and I'm sure many others, what's actually going on? Is there some tussle between rates and risk markets in terms of their assessment of how long the war is going to go for? Or is there something else at play? And for that, I'll hand back to Dylan on the role of AI.
Thanks, Kris. So we think that AI can unify the moves in rates and risk markets. So obviously, with risk coming back on as investors have seen continued strong earnings, they've seen this continued strong capital investment into AI, accounting for up to 50% of U.S. economic growth in the past 6 months. So it's been a very big sort of factor in the U.S. economy, and it's been something that's really strengthened the conviction and sentiment of US-based investors, especially in our chats with them. We also noticed one other factor is many people talk about the productivity boom that is expected to come from AI, but obviously, like any new technology adoption, there's a first stage which is spending the money spending the money and trying to integrate, and that stage often comes with the spending and inflationary outcomes first, and then productivity is often harvested or reaped considerably later than that. We also saw that during the dot-com boom, there was the lag between the investments and the actual increase in productivity from the internet. And so we don't think this is any different with AI. There'll be time for companies to reorganize their activities, improve productivity, and fully implement them throughout their full value chain. Additionally, we would note that that inflationary pressure from AI spending is also doesn't help when we've seen the oil price impacts that Kris has mentioned earlier from the Strait being shut. That also puts further pressure on supply chains and so on. So that spending is money that can be earned by companies and equities, and seeing equities being quite strong and supported as their earnings growth has been quite good. Likewise, it's the inflationary pressure has hurt longer dated fixed income. So how do these recent events impact portfolio construction? So firstly, the first impact is obviously you've seen the yields increase, as Kris mentioned, and they've increased and haven't come back. And so that's yield to maturity is obviously one of the best predictors of forward-looking return for fixed income. If you hold it for the duration of the fixed income bond that you hold, that's often very highly correlated with the outcome of the return, often over 90%. Additionally, it brings to mind the risks around inflation and whether rates can continue to sell off, making investors consider the risks around longer duration and longer exposure to longer dated fixed income and whether that can continue to sell off. And finally, in a world of uncertainty where no one really knows how long the Strait of Hormuz will be shut, and no one really knows the level of inflation pressure that can build up in the system, it really does highlight the attractiveness of being very short dated, having a minimal exposure to interest rate risk, also credit and equity risk, and therefore really emphasizes what we think is the attractiveness of global short dated fixed income investment grade strategies, where they're going to get the coupon, and that sensitivity to the unknown outcomes within the market are limited by having a small exposure to those. So when you think about the attractiveness of fixed income overall, many investors obviously invest in Australian stocks and the Australian ASX 200. And what's quite interesting is you've seen the RBA cash rate now exceed the dividend yield on the ASX 200. That obviously brings forth attention on, well, maybe fixed income is looking fairly attractive compared to equities, and at least Australian equities. Penalized the other element of what we're seeing is the recent changes to tax have emphasized, if they do go through, will penalize growth investors and therefore penalize equities comparable to compared to fixed income, which has less of a growth tilt and more of an income tilt. The other element worth considering is actually that, as I mentioned earlier, is yield to maturity does tend to be a leading indicator of forward returns for fixed income. On the right-hand chart, it shows in dark green the yield to maturity of the Kapstream Absolute Return Income Fund, the Cash Plus 2 to 3 fund, and you can see that the light blue is the rolling returns with the 12-month rolling returns, and you can see that the returns tend to follow the yields with a bit of a lag, give or take. And so given that the dark green line is getting towards the high end again, approaching that 6%, we're fairly optimistic on short dated global fixed income here, given that historic correlation and relationship. And with that, I'll pass to Kris to talk about the correlation between rates and risk markets.
Yeah, thank you, Dylan. So yeah, we've just spoken about how higher yields is actually a good thing for fixed income. So there are some positive benefits from the impact of the energy price shock on expected returns, and being above the dividend yield for the first time in a long time is a big plus. But the other thing that a lot of investors have spoken to us about is what's going on in terms of the correlation between rates and risk markets, whether you're talking about equities or credit. There's been a lot more discussion around this. And what this chart shows is what's the rolling 5-year correlation between rates and equities. And we're using the US 2-year Treasury future here just as on the rate side, and for equities we're using the S&P 500. Both very well-known measures to be thinking about. And you can see that most of the time over this 20-year history or 20-year plus history is you've seen a negative correlation. Most of the time it's been negative, but over the last 5 years, the last 3 years, I should say, that rolling 5-year correlation has actually turned positive. You've actually seen more of a positive correlation between risk and rates markets. So people have, understandably been asking what's going on. That negative correlation is the basis for a wide range of portfolio construction concepts, in particular the 60-40 portfolio that everybody talks about. That's really relying on a negative correlation between rates and risk markets to help justify why you'd have that 60-40 split between equities and fixed income. So if there is a lack of negative correlation going on, people have been understandably asking that a little bit more. And a lot of people have concluded, the jury's still out on why that is. A lot of people and a lot of the research and presentations that we see are focusing on whether or not you're in a high inflation or low inflation environment. It's when you're in a high inflation environment that you actually see the correlation potentially flip around the other way. And our view is that's probably correct, but our view is a little bit more nuanced. We actually think it's more when you get supply shocks. That's when you get the correlation turning around the other way. So that period between 2000 and just before COVID, there weren't a huge number of supply shocks relative to the 70s and 80s where there was a significant number of supply shocks. But in the past 5 years, we've had COVID, which was a supply shock. We've had the Ukraine war, which pushed up energy prices temporarily there. And then more recently, we've had the military conflict in Iran pushing up energy prices as well. So we've had a number of supply shocks over the past few years. And we see that as being more relevant as the reason as to why this correlation has turned around from being negative to positive. Now, what does that mean for portfolio construction? Well, if you don't have that negative correlation, or if it's there less often than what we've seen in history, then the desire or the need to have long duration fixed income funds in your portfolio is arguably a little bit weaker than what it would be otherwise. So these other high duration funds, if they're not providing an offset to equities when equities are doing poorly, then there's less of a need, or the optimization processes are just going to give you a lower weight on these going forward. So that's something else that's really come out of discussions in the past few months in particular. Well, it's actually been the past few years that people have been talking about this correlation not being there. So it is something which does point towards moving away from the longer duration fixed income funds. And again, we think that promotes having more income focused short duration funds in people's portfolios.